The elephant in the room, as Tokyo's financial duct tape peels, is global asset pricing nearing an end. Introduction: the misdiagnosed crisis. If you've felt a sense of economic anxiety over the past year, you likely attributed it to geopolitical conflicts, persistent inflation, or the fear of AI-driven job displacement. Mainstream media will tell you the greatest risks to the U.S. economy are political volatility, trade wars, or interest rate pivots in Washington. But the reality is far more subtle and systemic. The true deep-sea monster is lurking in one of the most boring office buildings in Tokyo, the Bank of Japan, BOJ. For 30 years, the prosperity of the global financial system has been built on a silent, singular premise: Japan will provide nearly free capital forever. Japan has acted as the world's financial duct tape, quietly patching liquidity holes after every major crisis. But that tape is starting to peel. This isn't just a story about a minor interest rate hike. It is the beginning of a massive, multi-decade reversal of global capital flows.
Chapter 1: The Lost Decades and the Zero-Degree Lab. To understand today's crisis, we must go back to 1992. That year marked the catastrophic burst of the largest asset bubble in Japanese history. From that moment on, Japan entered an economic no-man's land. 3 decades of deflationary stagnation. During this period, the Japanese economy functioned like a precision instrument with no battery. Prices didn't rise, wages stayed flat, and growth vanished. To revive this Dead Sea, the Bank of Japan launched the most extreme monetary experiment in human history. They didn't just lower rates to zero, they introduced negative interest rates in 2016 and implemented a draconian policy known as yield curve control, or YCC. The essence of YCC was absolute. The BOJ drew a line in the sand, declaring that 10-year government bond yields would not cross a specific threshold. If the market dared to push rates higher, the BOJ would fire up the printing presses and buy bonds in unlimited quantities. They essentially welded interest rates to the floor. This created a bizarre phenomenon. While the rest of the world experienced inflation and volatility, Japan remained a static, zero-rate island. This island became a paradise for global speculators. Chapter 2: The Yen Carry Trade, Global Financial Parasitism. Because domestic returns in Japan were non-existent, Japanese insurance giants, pension funds, and millions of retail investors, famously known as Mrs. Watanabe, were forced into a world-changing decision: take the money abroad. This evolved into the yen carry trade, the largest and most widespread trade in financial history. The underlying logic was deceptively simple. 1. Borrow. Traders borrowed Japanese yen at near zero interest, sometimes negative, meaning they were effectively paid to borrow. 2. Convert. They exchanged that yen for dollars, euros, or Aussie dollars. 3. Invest. They buy higher-yielding assets, 4.5% U.S. Treasuries, Manhattan commercial real estate, Silicon Valley AI stocks, or emerging market bonds. As long as the yen didn't skyrocket and Japanese rates stayed at zero, this spread was a free lunch. Estimates suggest this trade reached trillions, if not tens of trillions of dollars. Consequently, Japan became the world's largest net creditor nation. Japan effectively became the public Wi-Fi and ATM of the global financial markets. When you see billion-dollar valuations for Silicon Valley startups or soaring home prices in Australia, there is a high probability that cheap yen is flowing through those veins. Chapter 3: The Collapse of the Model, When the Wi-Fi Disconnects. In 2024, the 30-year assumption, Japan will never raise rates, shattered.
As global inflation finally seeped into Japan, the BOJ realized that if they didn't raise rates, the yen's exchange rate would utterly collapse. They ended negative rates and scrapped YCC. The 2 rate hikes in mid-2024 were like dropping nuclear warheads into a calm lake. Why does a tiny 0.25% hike trigger a crash in U.S. stocks and a record 12% single-day plunge in the Nikkei? Because the mathematical model of the carry trade flipped. Rising costs, borrowing yen is no longer free. Currency backfire, rising rates cause the yen to appreciate. For carry traders, a stronger yen means they need more dollars to pay back the original yen they borrowed.
Forced liquidation. Sudden currency volatility triggers margin calls. To cover their debts, global speculators must instantly sell off their U.S. stocks, treasuries, and properties. This is a deleveraging chain reaction. When everyone rushes for the exit at the same time, asset prices go into a freefall. The market tremors in August 2024 were merely a dress rehearsal for this repatriation of capital. Chapter 4. The Secret of Long-Term Treasuries, the Myth of Fed Control. A common misconception is that the Federal Reserve, the Fed, controls everything. In reality, Jerome Powell only controls short-term rates, the long end of the curve, the 10-year U.S.
Treasury yield, which is the bedrock of all global asset pricing, is determined by market supply and demand. For decades, Japan was the largest foreign holder of U.S. debt. Whenever the U.S. government issued new debt to fund its multi-trillion-dollar deficits, Japanese investors were the most reliable buyers of last resort. The nightmare begins now. If bond yields in Japan begin to rise, why would a Japanese life insurance company take the currency risk of buying U.S. bonds? If they choose to move their capital back home, repatriation, the U.S. bond market loses its most critical bag holder. When buyers vanish, yields, and thus borrowing costs, must rise to attract new buyers. This explains why the Fed talks about cutting rates, yet mortgage rates in the U.S. remain painfully high. As long as demand for long-term treasury shrinks, global borrowing costs will never truly return to the floor. Chapter 5. Valuation Reset, the Gravity of All Assets. Why is bond market volatility the mother of all markets? As billionaire investor Ray Dalio points out, the risk-free rate is the foundation of all asset pricing. When financial analysts value a company, they use the discounted cash flow model. In this formula, the denominator is the long-term yield.
As the cheap liquidity provided by Japan disappears and yields rise, the denominator increases. This causes the valuation of all companies to shrink like a deflating balloon. Even if a company like Nvidia reports record earnings, if the underlying interest rate remains elevated, the multiple PE ratio investors are willing to pay will drop. This isn't just a numbers game. It means corporate financing becomes harder, startups go dry, and even ordinary car loans become more expensive. The oxygen concentration of global capital is dropping. Chapter 6. Media Short-Sightedness and the Real Echoes. Why don't you see this analysis in mainstream headlines? Because the compression of cross-currency carry trade spreads is not a clickable headline. People prefer discussing political scandals, AI consciousness, or how much Nvidia gained last week. Those topics require no barrier to entry and ignite instant emotion. But as a rational investor, you must understand, visible risks are usually already priced in. It is the boring structural shifts in the basement of the financial system that have the power to destroy everything. Japan is no longer a background player. It is shifting from a supplier of liquidity to a predator of liquidity. This is a paradigm shift the world hasn't seen in 30 years. Conclusion. Rebuilding your wealth foundation in an era of uncertainty.
The unwinding of the yen carry trade is not a single event, but a protracted process. In this process, the receding tide of liquidity will reveal who has been swimming naked. We are entering a new financial era. Volatility is the new normal. Global assets no longer have a stable fountain of cheap money. The return of logic. Valuations will no longer be driven by storytelling, but by the ability to generate actual cash flow. Watch the foundation. While keeping an eye on Washington, you must constantly observe Tokyo and the global bond supply-demand balance. Liquidity is the oxygen of the market. When oxygen is plentiful, everyone can run a marathon. When oxygen is thin, only the strongest survive. Do not be misled by the noise of headlines. The real storm is quietly brewing in the depths of the Pacific bond markets. Subscribe to this channel. We don't chase trends. We chase the deep financial undercurrents that actually determine the fate of your wealth.